Time now for an in-depth look at the market news this afternoon, and for that I'm joined on the line by Dr. Kim Sei-wan, professor of economics at Ewha Womans University. Professor Kim, good afternoon. Thanks for making time today.
Good afternoon, Devin.
Well, last month, Professor, data show Korea posted a trade surplus for the first time since November. In fact, it was the biggest surplus on record for February, led by the traditional semiconductors and petrochemicals. Tell us about that data and what you see happening on the trade front.
Despite the spike in imports due to the higher oil price, Korean economy was still able to post a trade surplus of $840 million in February, which is a turnaround from the previous 2 months of trade deficit. Korea's exports stood at $53.9 billion, or jumped 21% in February from a year earlier, as overseas shipments of chips, automobiles, and other key products increased amid a global economic recovery. It is the highest figure for February since the ministry began compiling related data in 1956. Imports jumped 25.1% on year to $53.1 billion, also the highest for any February, due mainly to soaring global energy prices. But there are still lots of uncertainties ahead of Korean export for this year, like oil prices, Russia's invasion into Ukraine, slowing Chinese economy, and so on. So there could be some switching between positive and negative trade surplus for this year.
And as you mentioned, there are concerns, of course, that the situation in Ukraine will hurt Korea in trade, making energy more expensive, preventing Korea from exporting to Russia to an extent. The main thing, though, of course, would seem to be energy and certain commodities from Russia and Ukraine. What do you say, Professor?
Until the war situation is stabilized in Ukraine, it would be difficult to import production materials from both Russia and Ukraine. First of all, as you said, higher oil prices and LNG prices can seriously accelerate domestic inflation because we import 100% of oil and LNG from foreign countries. Actually, we don't much import from Ukraine because its main export item is wheat and steel products. But unfortunately, Korean economy depends much on Russian products like naphtha, which is one of the most important base materials for all chemical products, nickel, which is key material for producing automobile battery, aluminum, and even snow crab. Overall, the geopolitical factors in Ukraine will raise price level in Korea and global economy together.
Well, now let's take a look at the markets for a minute, Professor. Stocks on Wall Street have given up most of the big gain we saw last Friday. All three main indices on Tuesday were down more than 1.5%. The Korean markets were closed yesterday, but today they actually ended higher. What's the story in the global markets and here in Korea?
U.S. stock indexes fell Tuesday as Russia's invasion of Ukraine continued to whipsaw through markets. U.S. stock markets have been battered in 2022, with the Dow Jones and Nasdaq both posting their worst 2-month stretches since March 2020 to start the year. The war in Ukraine has further soured investor sentiment. The blue-chip Dow Jones Industrial Average lost 1.8%, while the tech-heavy Nasdaq Composite was down 1.6% on Tuesday. In Asia-Pacific, all stock markets declined on Wednesday. Japan's Nikkei 225 dropped 1.7%. Hong Kong's Hang Seng Index retreated 1.3%. And China's Shanghai Index also edged down 0.1%. Recently, the war in Ukraine became the largest risk factor in domestic market, too. The Kospi market marginally gained today by 0.2%, while Kosdaq advanced well with 1.6% today. Most of the domestic large-cap stocks declined today with foreign investors net huge sales in Kospi market, while LG Energy Solution, SK Hynix, and Kakao advanced today.
Well, investors, a lot of them are looking for safety during this conflict in Ukraine, going into bonds where we see the yield on the 10-year Treasury having fallen briefly below 1.7%, holding at about that level now, the lowest since January. And oil prices are now solidly above $100 a barrel. What do you see happening with the flight to safety in bonds and gold and the sharp rise in oil?
When markets becomes riskier, the U.S. Treasury bond is the king of the market. So safe harbor assets were in demand, pressing down U.S. government bond yields. The yields on the benchmark 10-year U.S. Treasury note fell to 1.71% Tuesday, its fourth lowest close this year, with investors betting that the Federal Reserve won't act as aggressively to curb inflation. The yields on German government bond fell into negative territory for the first time since January. Yields fall as bond price rise. Oil prices rallied, rising back above $100 per barrel to their highest level since 2014. Brent crude, the international oil benchmark, climbed $7 a barrel, or 7.1% to $104.97. Benchmark European natural gas price jumped over 24%. These changes will last until the geopolitical situation in Ukraine stabilizes.
Well, finally, Professor, with the Korean government's extra budget drawn up earlier this year, the year's projected deficit is now at least 71 trillion won, or about $60 billion. So double-digit deficits in the billions now for 4 years in a row. What do you make of the situation, Professor?
The fast rising government debt over Korea COVID pandemic will be one of the largest concerns to future president of Korea. Korean government is projected to see the fiscal deficit sharply increase this year in the wake of allocation of supplementary budget worth 16.9 trillion won, or $14 billion US. In addition, there is a possibility that fiscal deficit will further increase as two major presidential candidates, both of the ruling party and opposition party, have pledged to draw up new supplementary budgets amid growing uncertainty over the economy due to external factors as well as ongoing pandemic. According to government, the fiscal balance is likely to post 70.8 trillion won in deficit this year. Government's expenditure has also expanded under difficult situations. Through the revenue showed weaker growth, suggesting worsening fiscal soundness. So I think it is really time to enforcing government debt stabilizing protocol.
Well, we do have a presidential election coming up next week, of course, Professor. All of us will be watching that and having your analysis on what this might look like in the future. Thank you for sharing your insights with us today. We always appreciate it.
Thank you very much, Devin.